So now let's get into the actual trading of last week. Now, some of these trades I took, some I didn't. We're going to look at, as I say, the S&Ps, crude oil, and gold. I don't trade gold. A lot of people do. That's why I put it on here, to show you that it does work in that market just as effectively in the other two. These are three fairly liquid markets, the S&P being the most liquid. They're very different. I mean, oil is very different than gold, and the two are very different than the S&P. Sometimes they move in tandem, sometimes they move apart from one another, and at other times they just move on their own. So there's really, they can correlate. There's no question about it, especially oil and gold, but they don't have a perfect correlation, and they don't stay well correlated for very long. In the end here, what I'm going to recommend is that you look at two markets, and I like the S&Ps and crude oil. You can pick the S&Ps and crude, the S&Ps and gold, or gold and crude. It doesn't really matter. Or, something different like crude and the 10-year notes is another good market to trade. It's fairly liquid. It doesn't really matter what you trade. If you like, and you don't have to use the S&Ps. You could use the Dow, the YM, the Dow futures, or the NASDAQ NQ, the NAS futures, the NAS 100 futures. They work well. So does the Russell. All this stuff, all these things show up in all these markets, as long as they're reasonably liquid. So here's Monday's trading. Now, just to orient folks, I'm using a 3,000 tick bar chart. Each of these bars is 3,000, technically price changes, but for our purposes, we can just think about 3,000 trades. There were 3,000 trades that occur in each of these bars. During the normal day in the S&Ps, that's about equivalent to a 5 or a 6 minute chart, give or take. The market gets active. This was a fairly active day here. Then it probably is more close to a 3-minute chart. But during the middle of the overnight in the Asian session and even in the European session, a tick bar could be one tick chart could be an hour. It's not based on time, but what it does one thing very well, and that is it compresses the overnight data so that it's readable. If this was all 5 minutes, if this was a 5-minute chart, it would all be strung out and you really couldn't see what's going on. So that's one of the reasons why I use this. And also, if you're using an indicator, this standardizes your data. Every data point is built off of 3,000 price changes. So that's kind of nice. And if you do use an indicator, try a tick chart if you've never used one before, and the indicator will start talking to you in a different language. Also, we're using the Weiss wave here. This is the volume that aggregates on the swing or on the wave. Very useful on an intraday basis, and also can be used on higher time frames as well. So let's see what happens here. So just to begin with, you can see that we're trending down. I mean, that's fairly obvious, and we use a simple trending pattern to define that. We want to see a low. We have a high up here, and then we make a low, and then we have a lower high and a lower low and a lower high. Not a strong, terrifically trending market up to this point, but we note that when the market does try to rally up, because it kind of stalls here and it looks like it's trying to make a higher low for the first time, and here it doesn't do that, but it tries to. We see that the push up just has no demand on it. There's just really no fuel to drive this rally. There's just not enough volume here. Okay, so no upside volume. So we're looking at this, and then the market opens here, and we create a lower low. And as we do, now we're into about 10:10 in the morning Eastern time for the S&Ps, and we can see that we've got a good drive down. We've broken the last low, so we have a lower low here, and I see volume come into the downside. In other words, we've got larger downsides of volume. So this, as we said before, is selling over the buying, or supply overcoming demand. Okay? So this is a pulse down. Now we want to see the rest phase occur. Okay? And that, of course, comes in up in here. Now, note the price bars. Here's a way to do this. We look at these price bars, and most of them are overlapping. We come up, we come down, we come up, we come down, up a couple, then down a couple. Right? They're overlapping price bars. Also notice that the volume has picked up a little bit since the overnight, but not that much, and significantly less than the pulse down. Okay? Also, if we look at this and just compare it to here, and thinking in terms of flow, the flow down, or the drive down, was very easy, very free-flowing down. Coming up, it's struggling, it's choppy, it's trying to make its way up, and it's not having it's not moving up freely. Okay, so we would say that the flow up is poor and the flow down is good. The volume down is good, the volume up is poor, it's smaller. So we're looking for a short opportunity in here. Okay, this is the sweet spot trade in the trend. And so we can see that the market tries to move up here, and then we get bars 2 and 3, both pretty negative. Okay, so we would short on bar 3 here. As the market moves down, we take the close of that. It's taken out the low of the previous bar. It's taking out the closes of the previous bar. We've noticed that on the way up, we've closed underneath underneath the close once or twice, but we haven't really closed underneath the low of a prior bar. So that's the first time that this is happening. That signifies weakness in here. Okay, so that's one way to enter this market, is when we see a clear signal of weakness in the price action. A couple of other things to note about the price action. That is that we could never really get higher than the highs here for 15 minutes. And 15 minutes is a fairly long period of time in the S&Ps. Okay? And also the last 2 closes are both down. So as we're moving up, we want to see if the market is going to continue to move up, we want to see it move up, not start moving down. So we can enter on the price action. We can also enter it, we can allow the market to pull ourselves in. This is the second way to enter this market. Just making sure I'm not missing anything here. So another entry tactic is to let the market pull you into the trade. You can do this by sell stopping under either the last bar's low or the low of 2 bars back. Either one works fine. And they both work pretty much as well as one another. And stops in all cases are going to be above the rally high. A few ticks above the rally high. Okay, and that would be above the high of bar number 3 here. So we can enter this market either through price action when it turns decisively net negative, as it does here, or we can sell stop our way in. So you would, in other words, to do this, you would put a sell stop at this first red, a couple of ticks underneath the low of this bar. You might start here, but then then as the market moves up and doesn't take your stop, you move your stop up under the low of each bar until you finally get pulled into the market. It's a valid and useful way to enter the market. So here's yet a third way. I'll show you these 3 ways, and we'll look at other examples of them. But this is also a good way. You draw a trend line along the lows, and you can see bar 4 crosses and closes underneath the trend line. It breaks that trend line, and that's your entry. Again, you're giving up a little bit, but not much. In this case, the best entry would have been placing a sell stop a tick or two below each low. But my suggestion is that you do some personal research on this and pick the one method that you like best, that you think is best, and stick with it. Okay? Figure this out ahead of time. You don't want to be in the middle of trading and deciding, now, do I put a sell stop in here, or should I take the price action, or should I just do a trend line? You want to try to minimize the decisions that you are making in the middle of the trading day. And the way to do that is to do your research ahead of time and figure out, okay, how am I going to enter into this? I'm going to enter into it on a trend line break, or I'm going to enter into it I'm going to stop myself in. And so that's how you would do it. And entries on the sweet spot trades to the upside are going to be the exact same way. There's no difference to the up or downside. Which method used to derive your results? Well, I typically use price action to get in. Very rarely do I use the trend line break. Sometimes I will stop myself in. I use those too, but 95% of the time it's price action. And so I would be in on bar 3 here. I'd be in on the close of bar 3. Now, you can play a little bit of game with this if you want to. So bar 3 closes, and let's say it closes, I can't quite see, but let's say it closes at 23.54 even, right? And the S&P is moving quarter point ticks. So you could put a limit order 1 tick above that at 54.25, right? You put a sell limit in here, and if the market goes up by 2 ticks, you're assured a fill, and you get a little bit better fill that way if you want to cheat, so to speak. You can certainly do that. Do I ever go in on the market? Yes. If the market starts to really move down, it's moving down from a high, not where, for example, here the market's really moving down, but it's not moving down from a high, right? It's breaking down below. So if you went market short here, you're in trouble. When it's moving down from a high, and let's say that this bar was a little bit larger, and it was clear, and I've got a thing on multi-charts that will count the number of ticks or count it down. So I know when we're like 150 ticks away and this price bar is pretty, it's extended, well, then maybe I'll go in at that point. And I might use a market order. I might use a limit order, try to get in at a little bit better price. If sometimes it'll bounce around a little bit. I might try that. But if you want to get in, you don't want to sort of play around with it. You want to get in. If the trade sets up, you've got good confirmation that this is a good trade, like we have here, where you've got the pulse down, the volumes coming in, the choppy rally. We're coming back up into, I didn't put this in here, but we're coming back up into resistance in here. This is your spot in here. So just get in. Don't fool around too much. It's not worth it. There's a thing called tickitis that you don't want to, we don't want to try to buy the lowest tick or sell the highest tick. We just want to get in at the right area and then manage the trade from there. So here's a measured move. I took the pulse from the last swing high above this swing low, and just made a little line, and then you can do this with a trend line tool on most charting packages, and it gets you out about here. If we put in a trend channel, it gets you out at about the same amount. Granted, we're missing this down in here, but you don't know that that's going to happen. I wouldn't get excited about missing that. You've gotten, a nice, what is this, down to 50 from 56. You've gotten a nice 6 or 7 points out of here. That's a nice trade in the S&Ps. Be happy with that. So again, there's your target. You can play your target out at that point. And sometimes you'll see that the market is moving down really strong, and you might hold it for a little bit more. But in general, that's what you want to try to do, is get in, get out, and then assess how you did. So let's do a little recap here for the sweet spot in the trend. There are a few important points. The background conditions need to be conducive for the short trade. Okay, we're talking about short now here. So lower high, lower low leads to a lower high and a lower low. We want to see that supply or selling is dominant. And we saw that if we go back up here, we've got the conditions for the trade. Supply is dominant. That's pretty straightforward here. And then we want that weak rally up, that rest phase to the pulse, rest, pulse. We want that weak rally up where price bars are overlapping. The flow up is relatively poor. The demand volume is light or modest. It doesn't have to be, on the floor. It doesn't have to be super light, but we don't want it to be strong. Okay, we don't want it to be strong. That suggests that demand, there's no real strong demand in there. The entry is clear. You do it either through the three methods that we talked about: price action, the low of the last bar, or the low of the second to the last bar on a break, a stop-in break, or an uptrend line is broken. And then we have an exit on the measured move or a trend channel. And basically, they're both going to give you very close to the same target. And again, don't get too... You're shooting for general areas. Don't get if the market is half a point away from your target and it's showing you that it's not going down there, then don't wait to lose all your profits. Exit out and capture your profits. How much do I factor the hourly charts when exiting? You can certainly. The support and resistance on the hourly is, as you know from deep practice, something that we look at all the time. So you can certainly do that. I'm not talking about multiple time frames in here tonight because that adds a level of complexity that I didn't want to do. But you certainly can do that. If you're skilled in reading multiple time frames, then you can bring that into play in a variety of ways, not just support and resistance, but you can see the flow on the hourly, and that can tell you, well, maybe I want to hold on to this trade rather than to give it out. And just to play that out as an example, the flow here on the hourly, is right here. So this is your hourly bar from about here to here. Well, and it's closing down on the low by the time it gets down here, right? So you know that there's probably more to the downside, and you can then hold the trade a little bit longer. But for the basic trade here, the measured move or the trend channels certainly are good. Do I trail a stop? Generally, I don't. I don't bother trailing a stop. I have an emergency stop put in, and I will, I'll be watching the trade closely and carefully, and if managing the trade based on the price and volume action, and if the price starts to turn, then I don't want to stay. A lot of my exits, I have a target area of either a measured move or a trend channel or support resistance, previous swing high or low, and then I'm watching the price action around that area to tell me what to do. And most of the time, we will, the market is fairly forgiving if you get skilled in this. Very rarely does it come down and spike and immediately turn right around. And the bar will show you that you'll see a clear spike-like bar, a clear key reversal type bar when that happens, and you'll be ready to get out anyway. So that's Monday's trading in the S&Ps. Actually, not the whole day, just the morning.